Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is long verticals and diagonals. And sometimes a trader is just confronted with the fact they can't afford a stock. It's too expensive. But let's say we want to employ a covered call strategy, but can't buy the stock in order to sell a call in the first place. What might the trader do? Well, for some, this is a circumstance when they turn to a strategy sometimes referred to as the poor man's covered call. It's a diagonal spread. We're going to be talking about long call diagonal spreads conceptually in place of covered calls. Weigh sort of the pros and the cons of the strategy. We're going to be placing an example trade. Should be a lot to cover. But before we get to any of that, let me first of all say hello to everybody. It's already chatting in out there on YouTube. Great to see Robert and Randy, Will and Dragon Rider. Who else is here? Cedartown and Ted. Everybody, thanks for joining us week after week. We really do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live stream. If you'd like to be here, this is a Thursday webcast series, and it kicks off promptly at 11 Eastern time. We'd love to have you in our live stream audience. And I also want to let you know that my very good friend Kevin Horner is hanging out with the live stream audience. Kevin's going to be addressing any questions that I can't get to just during the natural flow of the presentation. As long as those questions are relatively on topic, if I can't get to them, Kevin's there to pick up my slack. Thanks for being there, Kevin. And Kevin and I would also like to issue an invitation to everybody listening, whether live or on the archive. Please follow us on X. That's a great additional educational resource available to you. No cost. You can find Kevin on X at Kevin Horner CS. You can find me there at Cameron May CS. But let's get into this discussion, the poor man's covered call strategy. But as we do that, I should say, first thing that we always need to do is to consider the risks associated with trading and investing. Risk is certainly real with options trading. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only, and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay. So with that said, let's outline an agenda for how we're going to spend this 45 minutes together today. First thing we're going to do is take a look at existing positions. We already have some long verticals and some diagonals in an example paper money account on the thinkorswim platform. So we're going to go have a look at those, see if any of them need any specific attention today. Then we're going to take a quick peek at the markets. I think there's something that's been interesting that's happened over the last couple of months that some technicians might be paying close attention to. And let's see if it has something to tell us about where the markets might be headed as we plan this new trade. But after we're done with a quick market overview, then we're going to get into this strategy, this long call strategy, sometimes referred to as the poor man's covered call. I'd say possibly some have moved more toward language of the poor trader's covered call. But in any case, yeah, we're going to be talking through the pros and the cons of the strategy and actually placing an example trade before we're done today. So let's go right to thinkorswim and have a quick look at our existing positions. So right down here, now this is the thinkorswim desktop trading software platform. It can be downloaded free of charge from your Schwab online account. You just go to the trade tab and look for thinkorswim as your keyword in the drop-down menu there. But just download the software, log in using your Schwab credentials, and you find yourself on a similar platform to what I'm demonstrating with today. But right down here at the bottom, you'll see long verticals and diagonals. So this is the portion of the portfolio that's dedicated to this webcast series. And we have 4 positions at the moment. 3 of them are cooperating, 1 not so much. So let's start with AVGO. Let's see what's going on with Broadcom. So with Broadcom, this is a long call vertical spread. We bought the 220 calls for February, sold the 225, those specifically for the 21st of February. And we'd like for the stock to be above 225 at expiration. Right now, it's not quite there. It was actually doing really well last week when we were convened. Had a bit of a hiccup, little bump in the road along the way. Let's see what's going on with Broadcom. So here are 2 lines representing our 2 strikes, 220 and 225. So we'd like to be up here where we were last week. But then we got that DeepSeek news from China. Boom. Broadcom took a big setback that actually put us from maximum theoretical gain territory straight down into maximum theoretical loss territory. When we say gain or loss territory, that's assuming that we're at expiration. Under most circumstances, even if we're in one or the other, it doesn't mean that we've accomplished maximum gain or that we've suffered maximum loss. So we dropped hard. But we've been seeing a bit of a rally since then, and we're sitting right at, look where the price is right now. We're at 218.35. We've actually been up into the middle of our two strikes today, hitting a daily, an intraday high already. This is only an hour and a half into trading today. We did get up to 222, so we faded a little bit from that high, but a decent recovery. We're going to see if we can continue to recover and get back up here into this maximum theoretical gain. Okay, Thaya asked a good question. What are these green and red colored portions? I just drew those on using the drawing tools down here, just for visual reference points as I describe our trades, okay? So, you don't have to do that. It's not something that's automatically applied. We will be using a tool a little bit later in the webcast. It's called the Analyze tool, specifically the risk profile tool within the Analyze tab. They can sort of draw this out for the trader, but not exactly the same way. Leon says there's some audio buffering. Keep me posted if that's persistent for everybody, but I'm just going to continue right now. I suppose that could be the case. In any case, we'd like to see, let's see if we can get right back up here. Maybe one candle, maybe two more candles. Seems like there could be sufficient time to get back up there, but trade needs some additional cooperation at this point. This is why we're underwater on this trade. So there are pros and cons for making that decision. We're giving it some time. We could get back up there. We're in max gain territory. That may happen. But if it doesn't, if we stay where we are, we could be struggling along and add additional losses. That right now it's just an unrealized loss. We could have larger unrealized losses. And if we're still down here at expiration, we're in the wrong spot. Audio is okay, BJ, thank you. That's exactly what I wanted to know. Ed says the audio is fine. BJ says the audio is fine. Dragon Rider says the audio is fine. So maybe, Leon, just refresh your screen and that might address that. But let's have a look at our next trade. Next trade is Cisco, another long call vertical spread. Bought the 60s, sold the 62.5 for Cisco. We'd like to be above 62.5. And right now at 61. Now that sounds like it's not cooperating. As a matter of fact, it is, because when we entered this trade, we weren't where the stock needed to be. So where we'd like to be is up here as we approach the 21st of February expiration. So let me drag down this right margin a little bit so we can see that territory that we're shooting for. We started the trade on this blue oval right here, this date, looking to get up above 62.5. We saw this bullishness after we previously entered a channel, and we're hoping to get back up there. So at the time, it was a low probability trade with a lot of reward potential. And right now we're starting to not realize, we're starting to see that potential. Haven't realized it until if we're able to close at a profit, that's when we realize the potential. So the stock has actually rallied up, pulled back. Now it's rallying again. It's moving in the direction we'd like. It seems that we might have some adequate time to get up there if it wants to get up there. However, there is something that we want to bear in mind. Between now and expiration is an earnings announcement. And that earnings could shoot us right up into maximum gain territory. It could drop us right back down into maximum loss territory. Nice thing about this trade is that we have much more to gain than to lose. If this were a coin flip, which it's not a 50-50 deal, but maximum gain is much larger than the maximum loss on this trade. So an earnings announcement may seem intimidating, but if among the potential outcomes are a much larger gain than a loss, maybe a trader is okay with holding over that. So with this trade, I'm going to let it continue to work. You can see with Cisco, it's moving in the right direction. Right now, $525 of unrealized gains. Unrealized simply means that we haven't closed out the position, so we can't say that we banked that money yet. So next up, we have Nvidia. Nvidia, I put on, was this last week's trade? It was. Yep. You can see that we put that trade on the 23rd. It's now the 30th. So this is a long put vertical. This is a bearish trade. Bought the 153 put, sold the 150 put, and what we'd like to see with this trade is for the stock to go down and stay down below 150. And look where we are right now, 118. We are way below 150. Here's what happened with Nvidia. It kind of got caught up in that DeepSeek as well. It took a bigger drop than our Broadcom position and has managed less of a rally. It's actually trading right down close to the lows of that drop, which is, fortunately, just what we would like to see with this trade. You can see here's our green maximum gain territory. What we're trying to avoid is being up here, and this is turning itself into a highly probable trade at this point. So when we started things off, it was looking a little bit sketchy. We were pretty close up there. We could easily have moved up into less than maximum gain or even up into maximum loss territory, but this one's cooperating. Now, what a trader might contemplate here, though, is it time to get out? What do we think? We put this trade on a week ago, and we did it for a cost of $2. $10 minus $8, $2 difference there. What we were hoping it was for this trade to turn into a $3 trade. When you have a $3 wide spread, the most we can make is $3 on that trade, theoretically. In other words, if someone were to put shares to us for 150, we have to buy shares at 150, but we can also sell those shares for 153. That'd be a $3 gain. That's best case scenario. How much might we be able to get out of this trade for right now? Jim says, when do we take the money? Well, Jim, we thought it might take us 29 days. There's still 22 days left on these contracts. Best case scenario, we were looking at maybe making $1 on our $2 investment in 29 days. Well, right now, it looks like we might be able to cash out with 90 cents instead of $1, but in a week instead of 29 days. How do I know that? Because the difference between our two strike values right now is pretty close to $3. You see that? $34.65 minus $31.75 is about $2.90. A little bit clearer right now. $34.70 minus $31.80, $2.90. We paid $2 to get into this trade. We might be able to close it out for $2.90. That's 90% of our planned original maximum gain. What do you think we ought to do? Well, for some traders, this may be a no-brainer. I don't like that phrase. Anytime something's a no-brainer means somebody may have turned their brain off. Let's turn our brains back on and talk about what are the pros of getting out, but also what are the cons of getting out right now. The pros of getting out right now is maybe we can cash in 90% of the maximum gain that we originally calculated. That's a big pro. But there's a subtle downside to this. There's still 10 cents left on the trade, and that's not nothing. 10 cents on a single contract is $10. We don't have a single contract. We have 22 contracts. That's $220 that could still be made on this trade. And there is a very high probability of success on this trade. If you remember our chart, we're way down here. The danger zone is now way up here. It seems that we have a pretty good buffer. As long as we're below our lower strike, as long as we're below 150, as we hit that February 21st expiration, we should be in good position to make an additional $220 on this trade. So is $220 something easy to walk away from? Not necessarily. That is something that we'd be surrendering. A very high probability, not a certainty, but a very high probability of making more money if we just leave it alone. So what do we do? One final consideration. Greg says maybe take a partial profit. That we could certainly do. And maybe I do that. Notice that earnings is after our expirations. That's not even something that we have to worry about with this trade. That's not something that maybe you come in and throw a monkey wrench into the works. But if we're sitting right now on a $2.90 total value of these contracts, we bought them for $2. Net between the two, they're worth $2.90. How much could we lose of that if the stock were just to shoot up here unexpectedly? While we're waiting around to make the extra 10 cents per contract, the remaining 290 is at risk. So it's not just the 90 cents profit that we're risking. Remember, we also have a $2 investment that we are still risking if this were to reverse course. So basically, there are $29 at risk for every dollar of reward at this point. So yeah, there are some considerations to be made here. So what might a trader do? Well, if we're paying close attention, maybe we just watch it, monitor it from day to day. We don't have the luxury here of talking it through every day to see what we want to do with it. I'm not going to talk to you again until next Thursday. So for today, we could leave the whole position alone. We could scale out of some of it. We could maybe get rid of the whole thing. That's what I'm going to do here. I'm going to say, that's great. Let's take the whole profit. Or I don't know. Actually, there's always a chance. For me, there's the trader in me, and then there's also the educator in me. Maybe for some, the trader might say, Cameron, get out. But my education brain is saying, let's take a risk so that we can learn from that risk if it goes south on us. I don't know, maybe the trader is saying, it's not the smartest thing to do. But the educator is saying, yeah, but if it goes against us, there is a no real cost learning opportunity there. So that, you know what, I'm going to do that. We have 20 contracts, 20 contracts, 22 days left on those contracts. Let's take off, how about most of it? How about we close out 15 of these? So I'm going to right click on this. Let's create a closing order, sell out of that vertical, but instead of closing out all 20, let's dial this down to just 15, leaving 5 on so we can continue learning from those. Looks like the spread there, it's a pretty decent spread. Yep, when contracts go deeply in the money, as these puts have done, there can be a wide spread between the bid price and the ask price. It makes it a little bit harder to get out. We might not be able to get out with 90%. We might have to settle for 80 or even 70%. Let's see. Oh, and it's actually, yeah, it's still wandering from us here a little bit. Let's dial this down. How about we just take it, how much might we have to give away? Nah, I don't want to get out. Let's see if we can get out for at least 270. Bought in for $2, out for 270. Let's set that as our limit. May not be able to get a fill. Let's click confirm and send and see. So we're going to sell out, if we can, 15 of these verticals. There's certainly going to be a commission to do that, but it's 15 of the 21st of February, 153, 150 put verticals. Again, we're demanding at least 270 if we can get it. 1950 commission. Let's send that off, and let's see if paper money is going to be forgiving here. Oh, it is. Oh, look at that. Filled at 290. All right. So in for $2, out for 290. Best case scenario here theoretically was $3, so that's pretty close. So that is banked profit on those. We're going to see what happens with the rest. But that's definitely some opportunity to learn if these 5 turn on us. My guess is they're not going to, because that's the very most likely outcomes, that we're just going to make more money on these $5, but we'll find out. Now, finally, we have UnitedHealthcare, which is our long call diagonal. We bought a 21st of February, bought a 15th of January, 2027, 520 call. When we buy a long-term call, what we'd like to see is for the stock to go up. We have 715 days for the stock to just rise and rise and rise and help and help and help this long call. So we'd like for the stock to just go up. But at the same time, though, through the 21st of February, for the next 22 days, we sold a 560 call. If it helps to visualize these two, here's what they look like on our chart. So this was, again, UnitedHealthcare, UNH. We bought the 520 call, initiated the trade right back here. And from this point, what we'd like to see is for that 520 call's benefit, we'd like to see the stock go up. But at the same time, we sold a 560 call that expires on the 21st of February. That's why my red line terminates right there at that 560 level. That looks like that was previously an area of support. It may be a new price ceiling, at least temporarily. So we have kind of competing interests at the moment. Bullishness for the long call, but bearishness for the short call. We'd like to stay below 560. Best case outcome from here would be to see the stock climb, but just fall just short of 560. Let this one expire worthless while optimizing the upside of this one. Right now it's doing okay. That's just what it's working in the direction that we'd like, at about the pace that we would like, and hopefully we just expire, the short option just expires up there. So that is a long call diagonal, which is what we're also going to be talking about today. And that one's working fine, up $682. So we're going to leave that one alone. So now let's get into the meat of the discussion. We're going to be talking about this strategy, also known as the poor man's covered call. And as an example for today, I'm going to be using Gilead Sciences. So why did I choose Gilead Sciences? There are a number of things that a trader might look for as they're choosing a stock on which to do this strategy. Number one is the whole concept of this strategy is that it's sort of taking the place, in a way, of a covered call. Covered call is when we buy a stock, hopefully a stock that we like owning, that we bought it for logical reasons, but then we sell calls against that stock position where we're getting into shorter term obligations where someone might have the opportunity, they do have the opportunity to buy the shares from us at an agreed upon price. That's our covered call. Well, for some, they learn the concept of covered calls and they discover how these things can be kind of expensive. I got to buy 100 shares of stock. Yeah, depends on the price per share, the comparative affordability from one portfolio to the next. But for some, it may be a disqualifying event, just the price per share. So what are some of the considerations when we're entering into, let's say, buying a stock for covered calls, or similarly, choosing a stock to do a diagonal spread, a long call diagonal spread, or the poor man's covered call on? Well, one consideration can be price per share. This is a $96 stock. It'd be about $9,600 to initiate a covered call. Also, for some traders, they don't buy stocks unless they fit within the other requirements of their portfolio. Maybe they want a stock that's in a certain sector for diversification purposes. Maybe they're attracted to a stock for fundamental reasons, growth metrics or value metrics. I'm not going to get into those, let's say, assigning example rules for those today, but these are just some of the considerations, some of the possible pre-qualifiers for these. But also, beyond just price per share, beyond sector considerations, beyond fundamental considerations, are liquidity considerations. If we buy stocks with the intent of selling covered calls, or if we look at a stock with the intent of doing a diagonal spread, and it's an illiquid stock, it's almost certainly going to have illiquid options that have wide spreads between the bid price and the ask price on the options. It makes them difficult to trade profitably, and that's already difficult enough all by itself without making it harder. So those are some of the things that I was looking for in a stock. Also, for some, they look at what's happening with the chart. And what I noticed with Gilead Sciences, just to sort of lay a technical stage for this discussion, is that it's had a pretty good year. It didn't get off to such a great start, but it's been making higher highs and higher lows, settled into a trading range recently, found a support, and this support, I'm going to show you a longer term time frame here in just a moment. This is kind of interesting, around this $89 level, but it settled in between about 89 and 94, 89, 95, something like that, trading range. And just over the last few days, it seems to have pushed up through that range. Maybe it's making its way up to the next level of resistance. Yeah, there is an earnings announcement coming up. Yep. Now, with this strategy, I got to say, earnings announcements are just going to be sort of a fact of life. If we're getting into a longer-term trade, which this one is going to be, if it's going to extend anywhere beyond 3 months, and we're trading U.S. equities, if we're trading on the U.S. stock exchanges, earnings are just going to have to be dealt with. So, yep, I'm aware of that earnings. For some traders, maybe they wait to initiate until after that earnings, so maybe they can miss the first one if they're concerned about it. But for this strategy, there could actually be potential benefits for having earnings relatively close. So Anyway, but let's just say that our trader has looked at this chart and they're thinking, oh, this looks pretty good on a 1-year chart, upward trending, just broke through resistance. Maybe they're moving up, maybe it's moving up the next price. But on a longer term chart, let me bring this up on, let's not that, clicked on the wrong thing. Let's go out to like a 10-year chart. Here's something that's been happening with Gilead Sciences. Now let me check something here. Is my lighting flickering because I have a ring light? Let me hold on a second. I'm going to turn it off. It's kind of a distraction. Brand new ring light. Oh, well. I'll have to check that out later. Literally just put it up yesterday. Anyway, what's been happening in the long term with Gilead Sciences? Well, it hit a long time peak back here in 2015. Sold off hard and then found a long-term base over years, trading between about 60 and about that 89 level. And then it just finally broke up and through that. And when there's that much sort of pent-up technical energy, maybe for some traders, they see this as the likely beginnings of a longer-term move to the upside. And if it was trading in, let's say, a $30-ish range before, maybe it's set to trade in about a $30-ish range on that breakout. So possibly the trader has this long-term outlook for bullishness. So they might think, oh, you know what I'm going to do? I'm going to buy a stock. And maybe along the way, I'm going to sell calls against that stock position for a little bit of income, do covered calls. But for others, they might say, this isn't, in the grand scheme of the current market environment, $96 per share isn't incredibly expensive. But for some, they might say, I can't afford $96. So they might have to abandon the strategy, or maybe they turn to an alternate strategy. Sia was saying, Cameron, is this the 5-year weekly? That was actually a 10-year weekly. Let's talk about our alternate strategy. It's going to be our trade for the day, our example trade, not our example trade. There we go. Is a long call diagonal. And it begins with the same concept, basically, as why someone would enter into a covered call. It starts with long-term bullishness on the stock. But instead of buying the stock and then selling calls against it, we're going to buy the right to buy the stock. So instead of maybe laying out $96 per share, how about we go down and, this, just to go back to that longer-term chart for just a moment, it can take a while to travel these big distances, maybe a year or so, to go from lows all the way up to highs, lows all the way up to highs. And so if we're starting another big move, if we're to buy a 1-month contract, that may not be adequate. We might just be starting our journey and our trade's over. Stock's going in the right direction, we run out of time. So let's go to our trade tab and maybe go out as far as we can. There are contracts available on Gilead, 868 days on those contracts. And what if we were to buy, let's say, with the stock trading around $96, what if we were to buy the $95 call? Let's buy, as our example today, this, not the 7th, yeah, it is the 17th of June. 17th of June of 2027, $95 call. And that's trading for between 1540, 1625, split the difference there. Let's say it costs us 1575. So what have we just done for our $15.75? Well, if we spend that money for the next 868 days, so that's more than 2 years, 2.5 years, regardless of where Gilead goes, if it happens to run up and it runs way up, we know we have the right to buy shares of Gilead for $95 per share at any time for the next 868 days. We don't own the shares already, but we have the right to own the shares at a fixed price. And the cost of that right is $15.75. So when we have the right to buy shares, that has essentially the same effect of covering short option positions as actually owning the shares. You know, a covered call trader, or the phrase covered means that if we sell short calls and we get assigned, that's okay, position is covered. I got the shares right here. Well, if we buy a long call and then sell short calls against that position, it's still a covered position. Short call has the obligation to potentially have to sell shares at fixed price. Well, we already have a fixed purchase price as well. So this is still considered a covered position. So what the trader might do from here, conceptually, is sell calls against this long call position. So let's start this position off. As we buy this long-term call position, let's sell a short-term call against it. Let's pop up here. We could look at some weeklies. I'm going to go for this 21st of February, the traditional monthly expiration, third Friday expiration. They just tend to have greater liquidity than the weeklies. Okay, Paul, that's a good question. What happens if the price moves to be out of the money? I do want to talk through, what happens, what if scenarios, as I try to do that every time when I do one of these strategies. But let's go back to our chart here. And I'm going to go back to that daily chart. And what we're considering doing here is selling a contract through the 21st of February. That expires right here. And I notice there's that immediate overhead resistance. So maybe our stock might run up a little bit further, which is great for the call that we own, but maybe it bumps its head right there at about that about $99 level. I wonder what we could get for the $100 call. Let's go to our trade tab. Come down here for the 21st of February. That $100 call looks like it's selling between $1.10 and $1.20-ish. Let's say we get $1.15 for this. So we sell the 21st of February, and that's 2025. I'm going to put the 25 in there just so that we see the distinction between the longer term call and the shorter term call. And we're selling the $100 call for maybe, depends on where it fills, but $1.15. So this becomes very much like a covered call, but it is substantially different in its return potential. If we had purchased the stock at 96 and then we sold a call at 100, what we're doing there is we own the stock at 96 and we're agreeing we might have to sell the shares at $100. $1.15 on that $96 investment is what? It's about a 1% return. It's actually a little bit more. But we didn't spend $96. We've spent $15. So if we're able to sell this 115 contract against a it's closer to $16 investment, what's the actual return, the income potential on this short call? $1.15 divided by 1575 is about 7.3%. Yeah, so that's about 6 times what the potential percentage return on our covered call. Now, we all know that covered calls don't always work out, and we should certainly expect that long call diagonals don't always work out. But that's going to be our example trade for today. But let's draw that in on our chart. So first thing I'm going to do here is let's put a blue oval around our entry date. So we're entering right here. And on that date, we're entering into a long call. Let's actually nudge up. No, let's draw on a separate line. I'm going to draw on a line right there at $95 that represents the call we're about to buy. We right-click, edit the properties. Let's make that one green. It's the one that we're buying. And let's extend that to the right. There we go. So that's our long call. Our short call is going to be up here. Let's draw on a line up here, but this one only runs this distance. It's from today to expiration on the 21st of February. Let's right-click that, edit its properties. make it red. So there's our short call. So what we'd like for the stock to do from here is go up toward that short call. That's helping our long. But as long as it's below our short call, that should be in position to just expire worthless. And we have our then realized gain of $1.15. Ted says, should the stock move high enough to have an assignment on the sold call, does the leaps call cover the assignment? Ted, yeah, it is a covered position. Does that mean, though, that we should exercise our contract? So here's what Ted is proposing. This is definitely on my list of things to discuss. Let's say their stock does this. It goes right on up through our short strike, and maybe it's up here at 102, 103, 105, whatever. Up at that level, if someone has the right to buy shares for $100 and they're under and that's under market value, are they going to do it? Yeah. Very rare exceptions. They're going to say, Cameron, I want those shares. So you might think, well, this is a covered position, so I'm brilliant, and what I'll do is I'm going to then assign my contract. I have the right to buy shares for 95, and then if I sell them for 100, great. Not so great. Nope. These contracts don't expire for 2.5 years. There is 2.5 years of additional time value that's built into those contracts that would be immediately surrendered, evaporated, no return of value if we exercise our contracts. It is not mathematically the best idea if we get assigned on the short to exercise the long. So what are we left with then? If someone assigns a short call option, what that means is they just bought shares from us and we don't have the shares. We have the right to buy the shares, but we don't wanna, because the call option is too valuable. So here's what the trader might do in that case. If the shares are purchased and we don't own them, and we decide not to exercise our contract, what that leaves us with is we still own the long contract, but we're also then short the stock. And the trader probably at that point would want to just, if they want to, they could hold the short stock position if they think the stock is then going to go down, but no, they probably just want to buy those shares back at the market price. And if they were assigned shares, if the assignment allowed the purchase of shares at $100 per share, they got paid $100. So they have $100 per share to go shopping for some shares. They might have to come up with a little bit of extra to make up the difference if it costs more than that. So Ted, yeah, it's a good question. If the short gets assigned, should the long be exercised? And the answer is almost always no. Okay, especially with these really longer term options. So let's do our trade. Let's do our trade. So this, again, I just want to emphasize, this is why they call it a poor man's covered call, because instead of having to spend $96 to buy the stock, we spent $16 to buy the right to buy the stock. And now we can go ahead and sell a covered call, a covered short call position, not a covered call, but it's a covered position, theoretically. I say theoretically because it is, but it doesn't necessarily mean that we'd want to exercise every time, just, in the event of assignment. So let's go place this trade. I'm going to go to the trade tab here. And here's a quick way to build a trade. Lots of ways to do this, but we know which option we're thinking about selling. We know which option we're thinking about buying. So while we're here in the contract period, the expiration period that we're planning on selling, let's go to our 100 strike, and I'm going to click on the bid price to create an order to sell. There we go. And then we're going to go, let me just minimize this order field. It didn't erase my order, it just hid it down at the bottom. Now we're going to go out to the 17th of June for 2027 and go to the strike price that we were considering buying, 95. And I'm going to hold down the control key on my keyboard, which is telling the system that I'm about to add a second order to the one that's already in place. So while I'm holding down that control key, I click on the ask price, and that creates my diagonal spread. Buying 17th of June for 2027, 95 call. Selling the 21st of February, 100 call. And this is going to be our initial diagonal. Now, what the trader may have in mind as their, if they could draw up a dream vision for the next 2.5 years, what's probably in the trader's head from here? Well, their dream vision may be, I'm buying this $95 call, selling the 100. We'd like the stock to go up, but just come up just short of 100. That call expires. It's out of our way. And then at that point, we sell another call, maybe at 105 for the next contract expiration cycle. And then if the stock keeps going up, still helping out our long call, the next one expires worthless. It's out of the way. We have a realized income on that. And then maybe we go out another month and we sell $5 or $10 higher. That's the vision. That's the perfect outcome. It's things don't work out perfectly very commonly. But that's probably what the trader has in mind, much like when they own a stock and they want to sell calls against that stock. Hey, as the stock is rising, maybe I want to sell calls, maybe get some income along the way. Same concept. But let's click confirm and send here. Looks like it's going to net, it'll be a little bit short of $15. And actually, in this webcast series, we typically spend around $4,000 or $5,000 on a trade. So let's do 3. There we go. I'm going to click confirm and send. We're going to buy 3 of these diagonals, the 17th of June, 2027, 21st of February, 2025, 95, 100 call diagonals. Let's see, our limit. What's our, I think we're going to have to nudge our limit up here. Let's actually edit this. Let's move our limit closer to the natural, saying, yeah, we might have to pay more for the long call or receive less for the short call or some combination of the two. Just willing to spend a little bit more to get into this trade. So let's pay up to $1,500 per diagonal. There is a commission to be paid on this trade. What's the potential trade outcome? Well, we'd like to get up to about $100, and that's where we optimize our outcome. Let's send this order off. See if we can get filled. Now, as we're waiting for that, let's see if it's, okay, 1467 mark, $15 is what we're offering. I think this is going to fill pretty quickly here. One thing that I didn't get to today that we'll do in a future webcast is use the Analyze tab to just take a look at the potential profit and loss scenario. We already did it on the chart. It would be a different way to view things like we did as we were looking at the green and red boxes on the chart. But that's it. We are in our long call diagonal spread, also known as the poor man's covered call. We're going to see how this goes, but for at least this time, for the next 22 days through the 21st of February, we'd like the stock to go up, helping out our long call, but remain below our short strike. So hopefully that income just is realized when that contract expires worthless. Bill says, so you don't want to exercise your call until the stock price goes past the call plus the cost of the call. Maybe not even then, Bill. Maybe you just sell it. That's probably the more profitable outcome, even in that scenario. All right. But everybody, we've accomplished what we set out to do today. Let me bring this back up. But we reviewed existing positions. We took a look at the markets, and we built out this strategy, the long call diagonal strategy. Talk through the objectives of the trade. One thing I really want to emphasize, though, is that if the stock turns around and goes down, we got $15 on the line net. If the stock starts to collapse, that can be damaging to this trade. So we're going to keep an eye on that. All right. I didn't spend quite as much time as I would like on the risk of the trade. So let me just end the webcast discussion with an exclamation point. There is risk in this trade, and that is it's a bullish trade. If the stock behaves bearishly, could lose it all. So we're going to keep an eye out for that. Anyway, but everybody, time for me to let you go. Thanks, Kevin, for helping out in chat. But as you go to enjoy the rest of our webcast through the rest of the day, remember, you have other resources outside of these live stream discussions. For example, first of all, make sure that you're subscribed to our Trader Talks channel, which is where you can access the playlist for our previous webcasts. So it's Trader Talks Schwab Coaching Webcast. It doesn't cost anything to subscribe. You can go down, click on the subscribe button right now. If you haven't done that already, do that quickly. But this is where we host our playlists of previous webcasts. You can join the live streams here as well. Another thing that I would strongly suggest, also doesn't cost anything, is to follow Kevin and me on X. If you have an account with X, go give us a follow. You can follow Kevin at Kevin Horner CS. You can follow me there at Cameron May CS, but that's the best place to connect with your favorite presenters in between the live streams. All right, everybody, thanks for all the likes. I see lots of thumbs up out there, 179 people watching. Already fully a third have clicked on the thumbs up. 60 people I could see have clicked the like button. That's definitely appreciated. That's like applause to your presenter. It also gives us a boost in the YouTube algorithm, helps us find a wider audience, help more people. So thanks for doing that. But I will see you at a future webcast. That might be next Thursday for another discussion here, or one of my other webcast series. I have something new every day of the week. But I'll see you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.